Hi, I'm Damien Paterson, Managing Director of Paterson Financial Planning. I thought we'd do a quick bite-size introduction to protection for businesses, which can incorporate various different aspects and different needs depending on the circumstances of the business itself, the directors that are in the business, staff and various other aspects. So just looking at what kind of things are needed. So usually we start at the top, which is the structure of the business, and we think, okay, how is that business constructed? If it's a limited company, we'll kind of, for the purposes of this video, we'll make a limited company the default. But for a limited company, let's, for example, say there was two directors, two different individuals. Let's call it Mr. A and Mr. B, just for simplicity. Mr. A owns 50% shares and Mr. B owns 50% of the shares. So what we know is that under normal circumstances, unless there's been a change to the Articles of Association, that should Mr. A pass away, die, then effectively, if he was married, for example, then his spouse would inherit the shares and effectively then be part of the board. So what we normally look to do under these circumstances is to have a cross agreement so that the shares were bought out by the remaining director or by the business itself to retain the shares within the business. Now what is important at that point is to ensure that the business has enough capital to do that. So the simplest and most effective way of doing that is to set up an insurance policy, which is effectively sometimes you're doing it on the life of another. So if you imagine that Mr. B is insuring Mr. A's life, just for the purposes that if Mr. A was to pass, that Mr. B would purchase compulsory purchase the shares from Mr. A's spouse or beneficiary. So that's kind of a very quick overview of share protection. Obviously very different variations within there, and the more directors and the more owners, the more complex and need for good planning that comes from that. Other things that are important for a business is to look at the debt within the business. So we'd look at sort of insurance for a loan protection. So often if a bank or lender was to lend a money business, they would request, it used to be that they insisted, but they would normally request that there was life insurance in place, that they would basically ensure that there was enough capital to repay that loan should the worst happen. For an individual or for various individuals within the business. That is also true of a business that holds shareholders' funds. So if you imagine a business which has profit, let's throw a number of 100,000 a year, but the directors only take £50,000 out, those funds build up, and effectively that is a debt to the business owners. And very often that's something that's overlooked and should be taken into account as part of the insurance planning process. So potentially you want to look at insuring that as a debt. So if again something happens, that debt can be repaid. Just sort of looking at the bigger picture, whenever you're maybe looking at share protection, things like that, it's all about valuing a business. So there's a lot of different ways of calculating that out. We would usually liaise directly with the accountancy practice that's involved to try and get to a figure that would be acceptable to that. Other things that are really worthwhile knowing is relevant life plans, which are basically plans that are on individuals' life. So it's almost like a personal life insurance. So if I take, for example, myself and think, right, okay, I can have a personal life insurance for the benefit of my wife and children, but paid for by the company, that is an allowable expense against the company. So by that I mean that they can offset it against their corporation tax. So it's worth sometimes at directors or even at staff level to kind of look at, well, what is it, if I was paying a a plan personally, so let's just say, for example, it was £100 a month for life cover for me. If I was paying that personally, I'd be paying it net of tax. So after I've paid myself and paid the tax, I then pay that amount. So I might need, just as rough figures, you might need something like 180 or £190 of earnings to pay that particular product. Whereas if the business paid it, the business, not only is it being paid gross, but it's also being offset against the corporation tax. So another 25% sort of reduction. So it's a really sort of a key component of planning and getting possibly more cover for less money. Just quickly, how that's set up is under a trust. So this is this Relevant Life Trust is something that was brought out to allow business owners to do this. It's not very well known, but it's there to be used. Lastly, we'd look at things like income protection, which is effectively like a sick pay. So if you work for a big company, often you'll get maybe 6 months and full pay before your sick pay would kick in. Statutory sick pay is very little at the moment. So these are almost like an extended sick pay, or built in for smaller businesses that don't have these type of cover. So you can have an executive income protection or a personal income protection. And without going into great detail, the basics of it are that it's set up so that an amount is paid every month. So either an individual could do it, or a business could do it and say, right, okay, we will insure you up to, for example, 75% of salary after a waiting period, as they call it, which could be 4 weeks to a year. The longer the waiting period, the cheaper the plan price. But the policy would effectively kick in and give you an extended sick pay, which can be done for a limited period of 1 or 2 years, or it can be done through to a specified age. So it could be through to age 60, 65, 67, in line with your company policy. So I hope that was useful. Bit of a whirlwind tour on that, but we are more than happy to have that discussion with you and look at your own individual positions and help out in whatever way we can. Thank you very much.